Tonight, tips and strategies for growing your investments and minimizing the tax bite. And later, the evolving landscape of the ETF sector in Canada. All this and much more on Money Talk with your host, Patricia Lovett-Reid.
Good evening. When it comes to tax-efficient investing, RSPs and TFSAs are the cornerstones of discussion. But is there more that we can be doing to minimize the tax bite? To discuss strategies on how to help maximize the after-tax income and grow your investments, I've invited Daryl Diamond. He's the author of Your Retirement Income Blueprint. Back on the show. Welcome back, sir.
Always wonderful to be here. Thank you.
You know, we often talk about retirement. We talk about it in a very generic sort of way. You know, save, put some money away, put some money in an RSP, tax-free savings accounts. But I think people really do care about taxes. I know they care about taxes.
Probably the biggest expense most retirees face.
You know, it absolutely is. And when you think about your retirement and you think about your RSPs, we often talk about mutual funds. And so one of the things I'd like to do is sort of break down the difference right off the top between a mutual fund and something you and I are going to talk about, a corporate class fund. So let's talk about a mutual fund.
Mutual fund is technically, by law, what's called a unit trust. That's
right.
why when you see your statement, it says you own so many units of a particular fund. That's how it's set up. A corporate class fund, same managers, same investment mandates, same name, but the word class will appear after the fund name. And it's set up in a very different structure. It's technically a corporation. So rather than owning units of a fund, you own shares. And for people with non-registered assets to invest, there are some very distinct tax advantages to having this structure set up properly.
Okay, so a couple of key points that you just made. One is non-registered investments. And what I find fascinating is these have been around for quite some time, like 1987, give or take.
1987.
And we're just not really all that aware of them. Why is this product not taken off?
It's not so much a product as it is a structure.
Yes.
So let's call that offering a structure. And the answer to your question is, I just don't think many people are familiar with them, including, by the way, tax professionals, accounting firms, really are all of a sudden grasping on to how significant these tools can be for people.
And the reason I bring that up is that because with a mutual fund, there will be distributions, and the fund can pay out those distributions pretty much any time they want, and you're taxed on them, and because they are a flow-through type of entity. And then, of course, if you redeem the shares, then you pay tax on. So really, the whole purpose behind exploring other options is to reduce the tax associated with the distribution.
Reduce the tax associated and also have more control over these monies. Well, with a corporate class mutual fund structure, again, you can have all sorts. You can structure your portfolio as perhaps a traditional mutual fund portfolio would allow you to do. May I also add, by the way, it's the same issue of distributions, whether it's individual stocks and bonds, whether it's ETFs.
Yep.
Anything non-registered other than a corporate class structure is by and large going to create taxable distributions. And you don't have any control over when those occur. The corporate class structure is, I'd like people to think of it as a tax deferral mechanism for non-registered assets. That's first and foremost one of the significant.
Yeah, we never talk about that.
No, and other than the TFSA, and you're correct, that's always stop number one. But for other non-registered holdings, the corporate class structure allows for basically very efficient, not perfect, but very efficient deferral of interest distributions, dividend distributions, and realized capital gain distributions that would otherwise, in a traditional unit trust mutual fund, be taxable every year, as you said. So we've got that deferral aspect working for us in the corporate class structure.
And how does that happen? How is it allowed to happen? I know it's because it's a share and it's a corporation, but you can move around, you've got flexibility in there. Explain how that works.
Here are the issues most investors have with non-registered holdings. We've talked about a couple. First, interest dividends are taxed in that manner. Foreign dividends are fully taxable as regular income, as you know. And the most efficient form of taxation of distributions is a realized capital gain. With non-registered investments in traditional investment positions, you also have potential for taxation upon rebalancing, potential taxation if we want to change investments. Maybe we want to go from Canada to the U.S. as an example. And these are things that appear in all other forms of non-registered investing. With a corporate class structure, you can make changes. You can take your entire portfolio and go to a cash equivalent position and not trigger a disposition. And the reason for that, coming back to the start of your question, is that the corporate class structure, the shares, it is treated like a corporation. You can exchange shares within a Canadian corporation and not trigger tax. So fees are offset by distributions in one sense, and I don't mean that the investor doesn't participate, they do, but the expenses are offset by what would otherwise be taxable distributions. Gains are offset by losses within this overall structure. And that's how we have this neutralization from a distribution point of view. Rates of return are almost identical to a unit trust fund.
Without the fees, because they get offset, without paying the tax on the distribution, because you can manage that.
So we have a very powerful tool to do two things: defer these non-registered distributions, and secondly, when they are realized, almost exclusively, it's in the form of capital gain, which is the most efficient way to be taxed.
Absolutely it is. Let's talk about the importance of net income.
Right.
Because this is what starts to drive some of the decisions around your non-registered investments.
For people who are retired, net income in that calculation is so important, because most of our government means tested entitlements or benefits, things like the age amount, age credit, things like OAS, are predicated upon someone's net income from year previous. So in structuring income from all the different sources that people have to create the cash flow they need in retirement, we always have a view to do it efficiently, watching that net income number. And so if we have, in a non-registered context, the ability to control distributions of interest, of dividends, of realized capital gain, that serves us very well in looking at keeping that net income number in check or low.
Without eroding the capital base.
Correct.
So let's walk through an example so that we can really see it with some clarity.
Okay.
I'll throw you the softball. You set it up.
Okay. Let me give you. It was a great example. It was a gentleman who was turning age 71 this last year, and it was a very, very good scenario in that he had built up his retirement assets perfectly. He had a bunch of non-registered money, and about to the tune of about $1.4 million, and he had RSPs that were in the range of about $1 million. For this gentleman, between his CPP receipt, his OAS entitlement, so the interest income he was receiving from the non-registered, and $1.4 million can kick out, even at low interest rates, a pretty good cash flow.
Yep.
He was really having sufficient income to do, after tax, what he wanted to do. His thought was, as his traditional thought, it was best to defer the RSPs as far as he could. But now he was turning 71 last year, and he suddenly realized that stepping into 2012, he had to bring out, on $1 million RSP amount, somewhere in the neighborhood of about $75,000, just over that, in income this year, taking his total income up to $158,000.
Now let's assume in this scenario you don't need $158,000.
And in his case, he certainly did.
He didn't need it. That wasn't the lifestyle he was supporting.
No.
All right. So that's the setup that he has.
Right.
He's got this $1.4 million in a non-registered account. What's he do with the corporate class shares?
Okay. If we take the $1.4 million in non-registered assets and move them to a corporate class structure, and within the corporate class structure, it can be as conservative, as balanced, or as aggressive as the investor wishes it to be. But what it allows us to do in a situation like this is, if I can use the expression, turn off the taxable distributions. In other words, the $73,000 and plus of interest income he was receiving, as we were able to have things come due, or as we are able to have things come due, will ultimately be more effectively sheltered, and there will be basically next to no income coming from that. He then is in a position, once that's under control, to start to bring this registered money in, and it'll reduce his taxable income dramatically.
And could potentially reduce the clawback of old age security.
Could very well.
Depending on where he's at. Maybe not in his particular case because of how much he's making. But when you look at it, it takes his actual net income down significantly.
Significantly.
And then ultimately down the road, you know, at some point, you have to take the money out of the non-registered. Is that dealt with at the estate level? If he doesn't need it?
The point...
is it time sensitive is what I'm asking.
No, and that's a very big difference from the RSP. So, for example, we have a minimum withdrawal. With non-registered assets, there is no such requirement. So when we talk about an aspect of control, it's far more tax effective for the individual if, and this wasn't the case in this scenario, if there is a survivor involved, much more tax efficient and friendly to the survivor and to the estate, way ahead of the game as opposed to deferring registered assets. As you know, in the Blueprint book, we always talk about combining different tax treatments to come up with the best end result. For non-registered holdings, the corporate class structure is just by far and away superior in helping us gain control and make most efficient use of bringing other assets into taxation.
Where can people find these corporate class structures?
Well, interestingly enough, and as you said, they've been around since 1987. There are very few investment fund companies that don't have them. Most of them do.
I know. I know. I asked the question, but I already knew the answer, and I hate when I do that to somebody. But that's what I find so striking, that it's just not that much more popular.
It's surprising. And actually, when we're dealing with client situations, one of the very first things we look for is to see how their non-registered assets are invested.
Yeah.
And this structure is so incredibly efficient. And I think what we love about it the most is it makes the unwinding or the exit strategy for the fully taxable assets just executed in such an efficient manner.
Okay, but what's the downside? Like, what are we missing here? What's the wild card that I just haven't hit on yet?
To the best of my knowledge, there isn't one. You're talking about a structure that wasn't just created yesterday as a marketing idea. You're talking about something that's been around since 1987 that is recognized in the Canadian Tax Act as an entity. So unless the rules change...
like they did with income trusts.
Well, like they did with income trusts, but again, you'd have to be rewriting... Remember, this is a corporation we're talking about. So you'd have to be dealing with all of that legislation. We just find that in terms of non-registered assets right now, there really isn't a downside to it at all. In certain offerings by different fund companies, because you asked where they were available, certain fund companies also have programs where, according to generally accepted accounting principles, as the expression goes, the management fee on these funds is considered an external expense and therefore deductible against other income. So if we've got a deferral strategy in place on the distributions, and we have a deduction available on the fee, that's a pretty attractive combination.
Boy, it's pretty hard to argue with you with any of this.
I have one more point to make.
Go ahead.
On these special offerings, on these special structures, what the fund companies, to their credit, have recognized, at least most of them, is that if they want to attract larger amounts of business, and for people with large amounts of wealth, this is ideal, as it is basically for anyone. But for large amounts of wealth, it's very attractive. They have structures that allow the management fee to be chopped down, reduced to the point where it's maybe 25 basis points or 30 basis points more than private counsel. Exceptional offerings, so efficient, and people just don't know about them.
All right, that's the rallying cry to find out about corporate class shares. You owe it to yourself to. Daryl, thank you for coming in.
Always a pleasure.
We'll have you back. I've been joined by Daryl Diamond. He's the author of Your Retirement Income Blueprint.